Man, I had a feeling in my gut that we were gonna get it no matter what, to be honest with you. So like it was I was obviously thrilled, but I wasn't shocked. I'm like they
Yeah.
want us to buy this building. We're allowing them to double end it. We've given them all the evidence and proof that we have the ability to close this building, and we've been buying in this market for the past year.
Hello and welcome back to another episode of the Refine Real Estate Podcast. This is season 2, episode 3, and I am with my co-host Manny. And we've got some exciting news that we're going to get to. We've maybe been hinting about it in the last 2 episodes, but yeah, we finally got some really good news on that. So yeah, before we get into that, just a reminder that I am a realtor and mortgage broker here in Halifax. I take my years of experience in real estate investing and help you and be that person in your corner. So any questions on any of those things, by any means, reach out to me. Always happy to chat, whether you think it might be a silly question, whether it's going to go find a deal, whether it's just you want someone to talk to. I am your guy. But moving on, Manny, what is going on?
Not too much, pal. I had a good weekend. I drove up to Amherst, which is about 2 hours away from Halifax. I had my second jiu-jitsu competition. It went pretty well. I got a silver medal this time around. So first competition, it was all right. This time I got a medal, and I have my next one in a month, and I plan on coming home with a gold medal that time. But it was fun. I always have a great time. It's always nerve wracking before, but like once you get on there, it's like you just forget everything, and it's like you're just in there to kill. So it was a great time. Other than that, everything's been pretty chill here in Halifax. Everything's going well. How about yourself? How was your weekend?
Yeah, weekend was good. Yeah, it's starting to feel like proper spring. I think what was the first day of spring? I think the 19th, something like that. So we are, if I've got it correct, we are actually in spring, and yeah, starting to feel like it some of these days, like out at the park, throwing a football around, and life is good. But then we get weeks like this where it's just like 25 mils every day, and the whole city is drowning. But yeah, no, overall things are quite well. Yeah, gearing up, getting some work going. So yeah, before that, the your competition on the weekend, was that uh, running out of steam again? I know you said in the first one, like your endurance was certainly tested. How'd you find this one?
Yeah, this time it wasn't like that. The first time, so I did gi and no gi. So any of our listeners, if you don't know what that is, gi is like the formal little outfit you wear. Almost looks like a pair of pajamas. Not quite, but that's kind of what they look like. So this competition, I only did gi. The whole competition was gi only. So I didn't do both. The first time I did both, and yeah, after I did the gi, when I did the no gi matches, my grip was dead. My arms were toast. I couldn't even open up a bottle of water. I had to get my buddy Ryan to open it up for me. So this time I didn't have to deal with that. I think my endurance overall has improved significantly anyways, but at the same time, doing both, it's tough, especially like if you're having long 5 minute rounds. But this time, I won my first match. We went the whole time, but it was pretty dominating. Like I won by points, and it was like 18-0. And then the second one, the guy was just very proficient with ankle locks, and he was able to sweep me and just get my ankle, and I couldn't get it out. I could have withstood it, I think, but then in my mind, I'm like, okay, cool. Maybe there's like a 10% chance I get out of this, but there's like a 75% chance he breaks my ankle, and then I can't train for the next month or two. So I weighed out the risk and reward of it, and I just let it go. I tapped. But one thing I love about these competitions, though, is I get to learn something that I need to work on, and it was very evident that I need to work on my entries into leg attacks and my defenses to them. So that's my biggest takeaway from that competition.
No, that's awesome. All right, moving along in the show. So we're going to do kind of two segments here. We're going to start with again some of the conversations you had in previous weekend when you were in Toronto, and then we'll get to the exciting news. So yeah, let's have you start.
Yeah, so my little section here will be the not so exciting stuff, and then we'll follow it up with the fun stuff. But this is more just a cautionary tale to investors in this market regarding promissory notes or any type of unsecured loan. I heard some just shocking news over the weekend of a couple of guys that I know that are prominent in the industry, and they're secretly, just robbing people blind, and people don't know it. Just like not paying back promissory notes, threatening bankruptcy, just doing really shady, terrible things to their investors. So I just wanted to, I think me, you, and Janelle, last season, we did a whole episode on the risks of lending and the benefits of making sure it's secured, or if not in first position, make sure it's second position. But yeah, unsecured loans, guys, unless you know this person so well that there's not a doubt in your mind that they're going to pay you back, whether that be because their their public image is so strong that they have to pay you back, or else it'll ruin their reputation. Or two, I don't know, you can go to their house and beat them up or something. But like that, other than that, because you have no legs to stand on if they don't pay you back. You can sue them, and that can be a lengthy process, and it might end up with nothing. Depending on what assets this person has, they can just go bankrupt, little things like that. So at the end of the day, you can loan them out X amount of dollars at whatever interest rate. I'm sure and the thing is, they're offering sexy interest rates. You're like, oh, 15, 20, 25%, crazy interest rates, awesome return on your money. But the risk is just not worth it, to be honest with you. And quick side note, I met a lady on the weekend that she's loaning out her money in very, very high risk situations, but she's charging them 40 to 45% interest rate. And I'm pretty sure she told me they're unsecured, but I'm like, man, they're not going to pay you back. That's what was going through my mind, to be honest with you. Now, if they are secured debts, that's another story. It might be illegal. I think we were talking about this a couple weeks ago. I think 39.99 is like the legal amount, right?
Yeah, I forget exactly what it is, but yeah, it's pretty high.
So, and I don't think a lawyer would secure a debt that's higher than the legal interest rate. So that's my question. So that makes me think that's unsecured. And she even told me they're very risky loans. That's why she's charging such a high amount. But regardless, that's just to say that people will accept these high interest loans when they're in a tight bind, because it's a very last resort. And then, if they don't pay you back, what are you going to do? You're just going to say goodbye to your money. Cool, you got 45% interest rate or 18% interest rate for X amount of months. But if you don't get your initial principal back, who cares? So yeah, that's just like a quick tip to anybody listening. Even if they're prominent in the real estate space and they have, a bunch of followers and, they've been posting for a long time, you don't really know what financial position they're in. You have no idea what's going on in the underbelly of their lives. And I would just very much want everybody that's listening to this to secure those debts. First position would obviously be great, but second position is also, it's better than nothing. And unsecured, I would steer you guys away from it if you take any advice from us.
Return of capital is almost as important as return on capital.
100%.
Our cautionary tale for the day. Again, you can go back last season. We did pretty much a full length pod on just that. Scenarios where, we've been in that situation, like borrowing that money, and it turned out quite well. Some of the situations we've done unsecured loans. Like we currently have some out on some other properties, and it's, it really, from us sitting in a position where we're using that capital, it's like, yeah, I know we have the best intentions. Life feels, we really want to make it work, but not everyone is as keen to do so. So yes, definitely a cautionary tale out there. So, okay, moving along. So anyone that maybe have listened to these last two episodes and then listening to this in succession might know exactly what I'm about to say. But for those of you that might just be jumping in on this one, we officially have the 97 unit building in Cleveland under contract. So it's very exciting for us. It was really cool how we found out too. So it was the two of us plus our partner Thomas. We were in an unrelated meeting, and he says, "Hey guys, hold on. This is the broker. I'm going to put him on speed dial or on speakerphone. You guys just mute your mics." And yeah, he put him on, and he was like, "Oh, hey Thomas, like I just calling to let you guys know about the deal. I just wanted to let you know that you guys have been awarded the deal." And so we all just like arms up, and we were celebrating, feeling pretty good about ourselves. So yeah, so that was really exciting. I know, these are the types of deals that I've got on like a vision board from 5 years ago about like it's a proper apartment building. It's and not to say that our other buildings aren't, but when you just look at this thing, and we'll certainly have probably by the time this podcast comes out, we'll have this building posted all over our social media, just doing an intro, have all the details available, all that good stuff. But again, it was like it was one of those scenarios where it's remind yourself of the wins, celebrate those wins, and we had a few minutes to ourselves to really reflect and be like, "No, that's awesome." So yeah, so as awesome as that felt, and as awesome as this is. The work's really just beginning now. So that's what we're going to spend the rest of this podcast talking about is, okay, so we've gone and we've gotten this large building. This is the equivalent to all the rest of the units we have down in the States. It has been a stepping stone. We went from 24 units up to 38, and we pretty much bought 38 properties at the same time. Now it is 97 unit, and we're getting excited about it. Manny, what were your thoughts when we heard that we got it?
Man, I had a feeling in my gut that we were going to get it no matter what, to be honest with you. So like it was I was obviously thrilled, but I wasn't shocked. I'm like, they want us to buy this building. We're allowing them to double end it. We've given them all the evidence and proof that we have the ability to close this building, and we've been buying in this market for the past year. Like we are their ideal buyer. So I knew they would come to realize it. So I was pumped, but I wasn't surprised.
Yeah, likewise there. Again, when we put all the energy and effort into doing that questionnaire, which we talked about in last episode, and how we're going to use that, like we really did pour a lot of energy and effort into that. So, and again, the questions are, what have you bought recently? And it was all properties within 15 minutes of this building, and just all the information that went along with those. So yeah, it felt really good to submit all that, and it feels great to be in this position. But we've got a very intense 3 months ahead of us. So the deal structure is it's about 45 days of due diligence for us, and then we firm up on the deal, and then it is a 30-day period after that to close. So we basically have to raise the money for that, do the due diligence on that. We have to figure out. So I guess these are the points we're going to go into at depth. So there's the lending side of it. So figuring out what lenders we're going to use, and what terms are involved with that, what flexibility we have, or what firm things we have to present. Then we have to talk about the structure of the deal. Then we have to talk about our due diligence period. Then we're going to talk about how we're going to market this deal to further along our efforts in the fundraising. So to start on that, Manny, maybe talk about where we're at for how we're going to structure this deal, and some of the potential options that we have.
Yeah, so we're in an interesting spot with this building. It's the raise itself is between $2 and $2.5 million USD. So we could go at it about it a couple of ways that we want, and we've discussed it amongst the group. So we can do it like we've been doing it with our previous deals. But the kicker is, if we're going to do that, we need to get a couple of buyers with some sorry, not buyers, some investors with some deep pockets. So we could do it like a JV style type thing. But that would mean, let's say we get five guys and they all drop 500K. Then it's a little easier and we can go about it that way. If not, and if it doesn't happen like that, we're going to have to go about it through a syndication model, and we have to get. So I don't know if I think we must have talked about what syndications are in the past, but it's just a way of crowdsourcing money to go buy apartment buildings, but you have to do it in a very legally appropriate way. With you need an attorney because you are selling securities at that point. And once we do it that way, then we can kind of take on investors that have less capital, and they are quite literally just passive partners. They are LPs, limited partners, and we'd be the active partners. There's really no downside to this except, setting up this entity or the syndication. It may be a little pricey at the start, 20 to 25K. But when we're talking about raising, $2 to $2.5 million, what's 25K, right? And so those are our two options right now, because let's say we have 25 people and they all want to give us $100,000 US. We can't. That's not a JV. There's no way that we can paint the picture where all 25 of them plus, the 4 or 5 of us on the active side, we're all working together in an active manner to kind of take down this deal and stabilize it. So I think depending on how many like serious heavy investors we get, it might be number 2. It might be number 1. It'd be very nice if it was number 1, the first option that I said, just for the ease of it all, having only a couple or a few investors to report back to and deal with always makes life a little easier. But we'll see. We'll see how the raise goes. I do know we have a lot of very interested investors on this one. I think we were talking about this yesterday, but like people, when they see a building of this size and stature, it's different. It's not like, for some reason, like the 24 unit building, it's a big building, but this new one, it dwarfs it, and people like that. It's just exciting. It's sexy. This can be a legacy project. Telling people I own a piece of this gigantic building in Cleveland, it entices people to want to invest. So I don't think raising the capital for this one will be a challenge whatsoever. It's just really kind of figuring it out, what level investors that we're going to have and how many are a part of the project with us.
So next up is the lending side of it. So again, when bidding on this deal, we reached out to some lenders, and I'll tell you, the lending down in the States is so different than what we have going on here. And a big part of that is due to how affordable things are down there. We've mentioned this on the past, but we'll mention it again. This building, so we have it under contract just over $4 million. If this exact building was in Halifax or Dartmouth or Sackville, even at the exact rents that it has right now, like we would definitely be north of $20 million. So to try and get the funding on something like that, even where the rents are exactly where they are now, like we would have to put somewhere
75%.
Yeah, 75% as the down payment, and the bank might lend us 25%. Whereas down there, again, because it's a much more affordable building, we don't even have to put 50% down. Because they've already worked with us, they see what our vision is on this building. They're actually offering loans in the ballpark of 70 to 75% of the cost, which means, we'll probably have to put about $1 million down as the down payment. Then the same lenders are also going to lend us about 70 to 75% 50% of the renovation budget. A renovation budget, again, this building definitely needs some love. There are some capital expenditures that need to be addressed, such as the roof and like the parapet wall at the top is the most pressing issue. That alone is, $650,000. Down the road, we're also going to have to address elevators. We're going to have to address cleaning up the hallways, and then the actual units themselves. So we let them know we're very transparent. Here's our budget. It's about 2.3 million, and they were like, "Yep, that sounds great. We can likely do about 70%, 75% of that." So right off the hop, by being able to borrow so much of the money for this project, it means we have to raise much less money. So if we had to buy, or if we had to raise all the money for a larger, 50% plus down payment plus the all the renovations, all the equity that's going to be available to investors is super diluted. So it's just, the returns aren't going to be as promising, and it's really not going to be an attractive project. But because we can leverage so much of that to our lenders, we can offer really solid returns on this. And again, as we continue to do our projections and our working with the lenders, we'll be diving into what our returns are going to look like and all that stuff moving forward. So yeah, that's just a quick snapshot on the lending. So next up is the rest of our due diligence. So if you want to speak to that, Manny.
Yeah, so the due diligence process, as you guys can imagine, on a 97 unit building, it's a little bit more intense than a duplex, Even the inspection process, it's like if you get an inspection on a small multi, they can probably do it in a day. This will most likely be spread over, who knows, maybe a week. And there's a lot of things that, the inspector will have to go through. And it's not just going to be like a regular home inspector. We're going to need, a team of different tradesmen to kind of walk this building with us in our team to make sure that there's no surprises. Because at the end of the day, like the biggest risk in a venture like this is that there's like a major capital expenditure that we don't see and that the brokers haven't, told us about. And then it's just like a huge surprise to us once we own the building. So making sure that, we do proper due diligence on the building itself is so integral. Other than that, the inspection, like the financing, like you just went through, like that'll be the biggest hurdle, making sure we kind of we already have the financing pretty much. It's just more so just raising the capital. But other than that, our property managers have been through the building with us when you guys were just down there. So they're already preparing to kind of be a part of this deal and manage it for us. They may have to kind of grow as a unit. There's just 4 of them right now, but they're about to add 97 units to their portfolio under management. So, I don't think Jessica can handle all that by herself. Jessica's the lady that handles the tenants mainly, and she's already handling 100 of ours and then a couple of hundred of their own that they manage. So this is, another 25% jump. So making sure they're ready to kind of take on the extra workload. And then another thing too, like we were talking about as a group yesterday, was just kind of managing the prices in relation to just renovations, making sure we have adequate money allotted to everything. That was some things that not mistakes, but some lessons learned that we learned from building 1 to building 2 to where we are now, is to make sure that we kind of overestimate and kind of have more money than we actually need for renovations, because the alternative is like when you're running tight, it's just, unnecessarily stressful. So here we have not made that mistake, and we'll be ready, but still managing the actual costs is integral here, making sure that we kind of run this thing as a tight ship, and talking to our property managers about that, and maybe buying stuff in bulk here. We kind of talked about that. You and Haran were talking about that, ordering stuff from China, because this is 97 units that we're renovating. Well, we aren't exactly sure if we're going to do all of them or half of them. That's the beauty of this deal. We have multiple plans, but regardless, we're renovating a lot of units, so we can kind of buy stuff in bulk, and we can be a little savvier with pricing on little things like that. And cutting costs and saving money all along the way will only make this a better deal and give our investors a better return. But is there anything else that I'm missing here about the due diligence?
No, on top of that, yeah, we'll have some other inspections like the environmental inspection and then, yeah, just having, certified people go through, like, check, like, is the boiler in good shape, and having multiple quotes, like, on fixing the roof, on fixing the parapet. We're going to get some elevator specialists in there, make sure the elevators are working well, those types of things as well. So it's not just a due diligence for the bank side of it, but also for our planning side of it as well. So then that really rounds out. So we know what we're getting into. We know that there's no way we can possibly predict everything that needs to be done, but to really have like a really sensible idea, and then, like you said, like have some extra to deal with the random things that come up or the things that we're not expecting. So yeah, that's the due diligence in a nutshell. So the next up is like the marketing of the deal and the fundraising from the deal. So again, at this point, we have a lot of people interested. We don't necessarily know who all is going to invest, how many investors we're going to have, all those types of things. So we're just starting small right now. Well, we get the rest of the paperwork all sorted for the deal. Is just talking to some of our bigger ticket potential investors, people that we know have a good chunk of funds that could contribute to this deal, or people that are part of a network that might be interested in this deal, and really just have those types of conversations, just preliminary conversations. And, we hope that we can raise, even call it $1 million just off that, get us, half the way or 40% of the way just off that. Then from there, what we're going to be doing is, again, we're going to be pounding the phones, having lots of conversations about this deal. But then on the online side, we're going to be sharing, obviously, on all the social media, all that type of stuff. But we'll also be doing webinars as well. So this is something I learned from being an M1. Basically, do it how they did it. Is they have pretty much weekly webinars where they do their presentation on the deal, talk about the returns, the risks, everything else, talk about Cleveland as a whole, but then they're actually able to answer a lot of the questions that people might have on the deal. So we'll be doing a lot of that, and really just a lot of time, energy, and effort into chatting with people that we know, and just letting people know like what the opportunity is here. And again, high level, it's we buy for a little, about $4 million. We put in roughly $2 million to $2.5 million into it. In 4 or 5 years, like this thing's going to be worth, 8.5, 10 million. And if we factor that along to like the year 10, if we could turn over the whole building, hold on to it, I mean, this thing's like close to like $15 million in value. So you can see like the equity growth is crazy. The thing already as is, like buying it right now, we're very close to the break-even mark. So again, if this was a $20 million asset up here in Halifax, similar rents, it would take the better part of 2 decades to get this thing to cash flow. We'll have this thing cash flowing in the first like 2 months. 2, maybe 3 months. And then from there, the building holds itself, it's sustainable, and then it's just all about optimizing it from there. So it's, it's a very exciting project. Again, we've looked at lots and lots of deals. This one, as soon as it crossed our desks, we ran some very quick high level numbers on it. And we were like, this is a winner for sure. When we were down in Cleveland, literally 1 block away from this building, we actually toured another building. That building was recently sold for about 85,000 per unit. And our deal we just locked up is about 40,000. So we know there's, just from the comparable sake, like, and then like about a kilometer away, or I guess a mile away, they had other deals that were selling for closer to 100,000 a unit. So we know that as long as we can get the rents up, keep the expenses down, get the capital expenditures done, that this deal is definitely worth in that $8 to $10 million range. So yeah, very, very excited about it. So yeah, anything else to add?
No, just to reiterate how, crazy this deal is. We don't see deals like this in Canada ever. I remember when we first were looking at this deal, we had another deal on our plate at the same time, the one in Columbus, and we we ran the numbers on both of them. We're like, man, one of these deals, it's like this might work if everything kind of goes perfectly, and then the other one's like, this is a no-brainer. And obviously we went after the no-brainer one, and now we have it locked up, and now we're ready to go. I think this is going to be an awesome deal. I can't wait to show you guys more. Make sure to follow us all on social, on Instagram specifically. Myself and Ian and the rest of our team and the Venture Co Capital page, and we'll have lots of video footage on this deal. I feel like you need to see this building. Talking about it is one thing, but like when you see it, it's a different feeling. So yeah, I'm pumped. I don't think I've been this fired up about a deal since like my very first duplex, and for very different reasons, obviously.
Yeah, absolutely. And I couldn't agree more. It's any way you slice this thing, it's like just exciting. It's just like, it's not by no means is it a get rich quick scheme, but it certainly is build wealth over time deal. So yeah, very much so looking forward to that. So again, hopefully by the time this podcast is reaching your ears, we have some content out about this deal. Hopefully by then we're starting up some of those webinars so we can really dive into the whole deal at a little bit more depth. Yeah, we're open books on this. So if you guys are interested about any aspects of this deal, or how we got to where we're making offers on 100-unit buildings, we're open books. So shoot us a message on Instagram, or any of the ways that you can get in touch with us. We're happy to chat, and we're very much so looking forward to presenting this deal to the world. So on that, thank you guys so much for listening to another episode of the Refined Real Estate Podcast. Again, please like and subscribe. Give us a 5-star review. We're hoping to continue to grow this to reach more people, inspire, answer questions, collaborate, all those good things. So yeah, we would really appreciate that. And we look forward to chatting with you all next week.